$20,000. That isn't the amount that makes you rich. It isn't enough to retire. It isn't enough to buy a luxury car or a dream home. But it is remarkably close to the point where one of the biggest power dynamics in the financial system quietly changes. Below $20,000 in liquid savings, banks, lenders, employers, and even landlords generally negotiate from a position of strength because they know your margin for error is thin. Above that threshold, they begin dealing with someone who can afford to say no. This isn't motivational advice. It's a structural reality. The Federal Reserve's 2023 survey of household economics and decision-making showed that households with accessible emergency savings experience dramatically fewer financial disruptions than those forced to rely on borrowing. Meanwhile, research from the Consumer Financial Protection Bureau has consistently shown that a relatively small percentage of customers generate the overwhelming majority of overdraft fee revenue. Those aren't isolated facts. They're clues about how the system is designed. Inside banking, there are terms the public almost never hears. One of them is relationship profitability. It doesn't simply measure how much money you have. It measures how much money the bank expects to make from your entire financial relationship. Your deposits, your loans, your credit card interest, your overdraft fees, and your likelihood of staying dependent on their products over time. That changes how institutions see you. Hey, I'm Brian, and I spend way too much time thinking about the invisible incentives hiding inside the financial system. Every annual report, regulatory filing, and banking conference presentation seems to reveal another way institutions quietly shift leverage toward themselves. Today, we're going to unpack why $20,000 matters so much, why banks behave differently around this threshold, and why crossing it changes far more than your bank balance. Along the way, I'll show you a metaphor that explains almost every financial decision large institutions make. Think of the financial system as a toll road. We'll keep coming back to that because once you see it, it's very difficult to unsee. Imagine you're driving to work every day on a highway, where every exit costs money. Every unexpected repair, every overdraft fee, every credit card interest payment, every expensive loan, every rushed financial decision. They're all toll booths. The bank owns the road. You pay every time you don't have another route available. $20,000 isn't the destination. It's the first exit ramp. Below that number, you're largely forced to stay on the toll road because almost every financial emergency has to be financed. Above it, you suddenly have options. You can take another road, you can wait, you can negotiate. Sometimes you can simply walk away. That is what institutions respond to. Not your income, not your job title, but your ability to refuse bad deals. Keep this toll road in mind, because every mechanism we're about to examine is really another toll booth that exists mainly for people who haven't yet reached that exit. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I appreciate you joining me on this finance journey. Layer 1. Overdraft fees. In 2022, United States banks collected roughly $7.7 billion in overdraft and non-sufficient funds fees, according to the Consumer Financial Protection Bureau. Even more revealing, the Bureau found that only about 9% of account holders generated nearly 80% of those fees. Banks don't build overdraft revenue around occasional mistakes. They build it around recurring financial stress. Internally, many institutions classify these customers as high-frequency overdrafters, not because they're irresponsible, but because their cash flow leaves almost no room for timing errors. Several regulatory actions over the last decade challenged practices like transaction reordering, where larger purchases were processed first, increasing the likelihood that multiple smaller purchases would each trigger separate overdraft fees. Those cases exposed something uncomfortable. The system wasn't merely collecting fees. It was optimizing for them. On the toll road, this is the first booth. Every paycheck that arrives one day late becomes another payment to keep driving. Layer 2. Credit card interest. According to data from the Federal Reserve Bank of New York and industry analyses, households carrying revolving credit card balances often pay well over $1,300 annually in interest. Inside the credit card industry, customers who pay their balances in full every month have long been jokingly called deadbeats. Think about that word. It doesn't describe someone who misses payments. It describes someone who never pays interest. From the bank's perspective, the least profitable customer is the one who uses the service exactly as advertised. Without meaningful savings, a broken transmission, or unexpected medical bill becomes credit card debt almost automatically. The revolving balance keeps generating revenue month after month. The toll road doesn't care why you had to borrow. It only charges you for staying on it. Layer 3. Maintenance fees. Many checking accounts still charge monthly maintenance fees of around $15, unless certain balance or direct deposit requirements are met. That sounds insignificant, until you realize the people most likely to miss those requirements are the same people already struggling to build savings. Someone whose balance briefly falls below the minimum during a difficult month can end up paying around $180 per year simply for not having enough money. The banking industry often refers to these minimum balance requirements as relationship qualifiers, benchmarks designed to identify customers worth rewarding with fee waivers. Notice the logic. The people with larger balances receive fewer fees. The people with smaller balances receive more. Another toll booth. The road becomes most expensive precisely when your tank is almost empty. Layer 4. The desperation premium research, published by the National Bureau of Economic Research and multiple consumer finance studies, has shown that borrowers under financial stress frequently accept higher borrowing costs, even when their credit profiles are otherwise comparable. Call it the desperation premium. Imagine two buyers with similar credit scores applying for a $30,000 vehicle loan. One has $25,000 in savings. The other has $2,000. The second buyer can't risk walking away because transportation isn't optional. That weaker negotiating position can easily translate into 1 or even 2 additional percentage points on the loan, costing roughly $1,600 more over its life. Banks don't have to force acceptance. They simply recognize when someone has no credible alternative. On the toll road, that's the express lane. It costs more because you can't afford to miss the exit. Layer 5. The psychological tax. Perhaps the most expensive toll isn't visible on any statement. A landmark study by researchers from Harvard University and Princeton University, published in Science in 2013, found that financial scarcity temporarily reduced cognitive performance by the equivalent of about 13 IQ points. Not because people became less intelligent, because constant financial pressure consumed mental bandwidth. Scarcity narrows attention. Short-term survival pushes long-term planning aside. Banks don't need customers to make irrational decisions all the time. They only need moments when stress makes expensive decisions feel unavoidable. That psychological tax quietly reinforces every other toll booth we've discussed. Financial pressure creates costly choices. Those costly choices create more financial pressure. The toll road becomes self-funding. Quick pause before we continue. If you're interested in understanding how financial systems actually work, not just collecting budgeting tips, consider subscribing. YouTube's recommendation system relies heavily on viewer engagement to decide which educational videos reach more people, so subscribing is one of the strongest signals you can send. I also put together a free financial leverage checklist that helps you measure the structural metrics discussed in videos like this, and you can download it using the link in the description. Let's get back to the number that changes everything. Behavioral economists often use the term outside option value, while negotiators call it your best alternative to a negotiated agreement, or BATNA. It's a simple idea. The stronger your alternative, the stronger your negotiating position. Take Claire. She worked in marketing and spent 8 years under a manager everyone on her team wanted to leave. The hours were unpredictable, promotions were delayed, and turnover was constant. Yet Claire stayed because she had only $6,000 in savings. Losing a paycheck, even for a month, felt impossible. Then an inheritance increased her savings to $24,000. Nothing else changed. Same resume, same experience, same economy. Within 90 days, she applied elsewhere, received 2 job offers, and when her employer countered with a 23% pay increase to keep her, she declined. That decision wasn't powered by confidence. It was powered by liquidity. The same shift appears in housing. A renter with enough cash reserves can reject unreasonable lease terms because moving becomes financially possible. A borrower with substantial savings can walk away from a bad loan offer because waiting is an option. $20,000 doesn't buy freedom from work. It buys freedom from urgency. And urgency has always been the toll road's most profitable customer. A few years ago, I spoke with a former retail bank branch manager I'll call Derek. He spent more than a decade working inside one of the country's largest banking networks. And one comment completely changed how I thought about customer profitability. I assumed the bank's favorite customers were the wealthy ones. Derek laughed. They're good customers, he said. They're just not always the most profitable. The customers the bank quietly loved were people earning somewhere between $50,000 and $80,000 a year, carrying a manageable credit card balance, occasionally overdrafting, maintaining a car loan, and using multiple banking products without ever reaching the point where they could simply opt out. Internally, every household contributed to what was essentially a relationship profitability score. It wasn't about whether someone had a high salary. It was about how many revenue streams that customer generated over time. The ideal customer wasn't someone in financial crisis. The ideal customer was someone under just enough pressure to keep paying tolls without ever leaving the road. Derek told me something else before we finished talking. Eventually, he stopped encouraging customers to stay in that cycle. That decision changed his career in a way he never expected. We'll come back to that in a minute. Let's see what this looks like with real numbers. Meet Smith. He's 34 years old. He earns $68,000 a year. After taxes and deductions, his monthly take-home pay is approximately $4,300. His monthly expenses look like this: $1,500 for rent, $600 for transportation, $500 for groceries, $300 for utilities, $400 for insurance, $500 for everything else. That leaves roughly $500 each month. For almost 2 years, Smith never managed to save more than $4,000. Every time he got close, life happened. A car repair, a dental bill, a family emergency. His savings account wasn't acting like a reserve. It was acting like a revolving door. Instead of trying another budgeting system, Smith made exactly one structural change. He opened a separate high-yield savings account at a different institution and scheduled an automatic transfer of $500 every payday before he ever saw the money. Nothing else changed. No raise. No side hustle. No extreme budgeting challenge. 20 months later, he crossed $20,000. Something interesting happened after that. His credit utilization steadily declined because emergencies no longer landed on his credit card, helping increase his credit score by 31 points. That stronger financial profile allowed him to refinance his vehicle loan, saving approximately $1,240 over the remaining term. Because he could comfortably absorb a larger deductible if something happened, he increased his insurance deductible and reduced his annual premiums by another $732. Most importantly, his monthly savings rate quietly climbed from $500 to $850, not because he suddenly became more disciplined, because the emergencies that used to interrupt his progress were now paid from a reserve that he replenished instead of financing through debt. This is what many people miss. Crossing $20,000 doesn't just protect the money you've saved, it changes the direction future cash flows naturally want to move. The toll road starts charging you less simply because you aren't forced to drive on it every week. There's a scene that captures this perfectly. A loan officer sits across from a young couple applying for financing. He's polite, professional, perfectly dressed. He smiles as he explains that the higher interest rate is simply what the system approved. He never asks how much cash they have available after closing. He doesn't need to. The algorithm already knows. It knows they can't easily walk away. The meeting lasts 15 minutes. The loan lasts years. The toll booth collected another payment before they even reached the highway. Here's the hidden mechanism. Modern consumer banking gradually shifted during the 1980s and 1990s, from primarily rewarding deposits to maximizing what institutions call relationship revenue, earning from every product attached to a customer rather than simply safeguarding their money. Consumer advocates and regulators have repeatedly argued that fee-based revenue models became deeply embedded over the following decades, while industry lobbying helped preserve many of the practices that made those models so profitable. The result is remarkably self-sustaining. The people who most need to build savings are often the same people paying the highest cumulative fees, interest, and financing costs. The money that could become tomorrow's financial cushion gets collected as today's toll. Remember Derek, the branch manager who stopped encouraging customers to remain permanently dependent on expensive banking products? That approach didn't earn him faster promotions. It made him less valuable inside a system measured by product sales and relationship profitability. Eventually, he left retail banking altogether. Ironically, many of the customers he encouraged to build larger cash reserves became the least profitable accounts on paper, and the healthiest households over the long run. That's the inversion the financial system rarely advertises. The customer who generates the fewest fees is often the one making the strongest financial decisions. Before you leave, check 3 numbers today. First, divide your liquid savings by your monthly essential expenses. If the result is below 4, you're probably negotiating from a weaker position than you realize. If it's approaching 5, you're getting close to that $20,000 leverage zone. Second, calculate how much you paid in overdraft fees, maintenance fees, and credit card interest over the last 12 months. That's your personal toll road bill. Third, ask one simple question. If I lost my income tomorrow, how many months could I comfortably say no to a bad financial offer? That number measures leverage far better than your salary ever will. The financial advice industry often has an incentive to make wealth building sound complicated because complicated advice is easier to package, sell, and endlessly optimize. The simpler path is usually the more powerful one. Build enough liquid savings that urgency no longer gets to negotiate on your behalf. Because the goal was never to own the toll road, it was always to reach the exit where you no longer have to keep paying to drive on it.